Hi everyone, it's Nevin Brenner, Realtor with RE/MAX All Points. I want to thank you for logging on and checking out my video here in the library of educational series that I'm doing. Today we're going to talk about a very important part of the home buying process, and that is getting ready to be pre-approved for a mortgage. There are certain things that you're going to need to do, some homework you're going to need to do, some information and tips that I'm here to help you with. I want to just make mention, I'm not a mortgage broker, I'm a realtor. I'm able to help you buy a home. I have a network of professionals that are able to help you in terms of getting pre-approved for a mortgage. This is just some information and some homework for you to get ready for that process. And I have lots of people, like I said, that will be able to help you. So let's do some little education first. Where are the places that you can find a mortgage? So some of the mortgage lenders that will lend you money. So first off, are conventional banks. So RBC, Bank of Montreal, Scotiabank, those are conventional banks. The benefit of using those places, if you've been banking with TD for 15 or 20 years, that's always a good place to start, because they're to inquire about getting a mortgage. You have a financial history with them. They're going to want to leverage that relationship with you so that you don't go to RBC and then open an account there. So you're in the driver's seat there with your current institution. Mortgage companies like a First National, those are non-conventional. Those are not financial institutions. Those are mortgage lenders. So if you use a mortgage broker, not your bank, but a mortgage broker, they will be able to look at up to about 30 different lenders, and they will find a place like First National that will be able to lend you a mortgage that you don't do your banking at. They're just mortgage lenders. Credit unions is another place. So if you are at Westminster Savings or Coast Capital, those are credit unions. They're a great place to get a mortgage. If you're banking with them, they're going to want to leverage that relationship with you. Trust companies or mortgage hedge funds, those are places that offer mortgages. Loan companies are often referred to as in the business as B lenders. If you have you want to do a home equity loan, you already own a home and you want to do renovations, or you want to pay down some debts, or you just have simply some credit blemishes or credit issues, but you still want to get a mortgage, secondary or B lenders will be able to provide that for you. The danger in using them, or not the danger, just so you know, again, a mortgage professional will explain this to you, but they often have large startup fees and or large interest rates, typically because those loan companies or secondary mortgage lenders, like B lenders, will or short-term fixes until you fix your credit. So if you decide to switch lenders after the process, it's very important that you make sure you understand the terms of your contract. Read everything. Always read everything. Read every line. Make sure you know what you're getting into. So let's get into the pre-approval process. And what does this mean? Pre-approval is when a potential mortgage lender looks at your finances and your credit to make sure and to solidify a maximum amount of money they're going to lend you, and as well as what interest rate they're going to charge you. With the pre-approval, you'll know the maximum amount that you're going to qualify for. You're also going to know your estimated monthly mortgage payments, and you're going to lock in an interest rate. That's really important that you understand this. When you get pre-approved, you're going to lock in an interest rate, the current interest rate of the day, for 60, 90, 120 days, depending on the lender and what they offer. That means it's very important that in the process for 90 days, you get the lower rate. Now, oftentimes, when the interest rates do rise and you have that locked-in interest rate, you get the lower one. So it's very important to make sure that you get a rate hold. Now, a common misconception in the home buying process, and I want to really make sure you understand this, pre-approval doesn't mean you're going to qualify for a mortgage. A lot of times people make that mistake saying, hey, oh, I'm pre-approved, I'm going to get a mortgage. No, pre-approved means money that the bank is willing to lend you, the amount, and the interest rate. When you attach a property to the home, to your pre-approval, when you put them together, that means you qualify for a mortgage. The bank is going to want to look, after you submit an offer, a contract of purchase and sale, which someone like myself can help you with. Once you attach that, then you qualify for a mortgage. The bank is going to want to look into a number of things, or the lender is going to want to look into a number of things. Number one, they're going to want to commission a home appraisal to make sure that that property that you're purchasing, you're not severely overpaying for it. And because if you do, and you if the appraisal comes back lower to the offer amount, the bank is going to want you to cough up the balance. So that's another thing. If it's a stratified property, a condominium, a townhouse, apartment, they're going to want to look into the strata documents, the Form B, the financial statements, the minutes. They're going to want to make sure what you're buying isn't going to financially strap you with upcoming projects within the building or the grounds. So once they okay the property, your pre-approval now turns into a mortgage qualification. So I just wanted to make sure you understand that. Pre-approval is just the money they're willing to lend you. Mortgage qualification is now they are going to look at a property and combine the money and the property, and then you get a home. Okay, so that's what I can help you with getting a contract in place. So further to that, I have some homework for you to do. So before you talk to a mortgage professional, it's very important you understand that I don't want you to go out today and start talking to all these different banks, or banks or lenders or brokers, because you don't want to credit surf. Credit surfing is when someone checks your credit and it actually gets attached to your credit. So the first piece of homework I have for you is check your credit yourself. Go to equifax.ca, enter your social insurance number, pull off your credit report. That credit report is loaded with lots of good information for you. First off, it's going to tell you about your credit score. And that score, the higher it is, the better of a risk you are for a potential lender. You're going to want to see open accounts like a Visa, MasterCard, if you have a car loan, all those list of open accounts that someone's lent you money and the status of it. So you want to make sure you're in good standing with all those different open accounts. And then you're also going to see who's checked your credit. So if you went credit surfing when you're shopping for a car, it's dangerous, because every time someone checks your credit, your score goes down. And you want to make sure your score is high, okay? So check your credit. If you have any questions regarding your credit, let me know. And I can help you, give you some ideas on how to build your credit back up. Second piece of homework after you've checked your credit and everything looks good, now I want you to provide or get some documentation in order. You need to obtain this. First off, you need photo government issued ID. Make sure you have that. As well, you're going to need proof of employment and confirmation of salary within that proof of employment. So you're going to need a letter from your employer. Go talk to your boss or your direct report and say, I want to go get qualified for a mortgage. I need proof of employment and confirmation of salary, and that you're not on probation, that you've been there longer than 3 months. Because I've had that happen with clients where they got a great job, they make great money, but they're still in their third month and on probation. They didn't get qualified for a mortgage. So the next thing you're going to need to do is collect some bank statements. So 6 months worth of bank statements. They want to make sure, your lender is going to want to make sure that the money's been in your account for a number of money for your down payment, that you have money to provide towards your mortgage and the closing costs. So you want to get those. You're going to also want to look at your assets, so things that you own. So I'd like you to go and collect information about assets such as a car, cottage, boat, any other secondary property, anything that you own as an asset they're going to want to look at. You're going to need to collect, the next thing you're going to need to collect and make sure you have and are up to date with are your taxes. You're going to make sure your recent notice of assessments, you have them. So from Revenue Canada, to make sure your taxes are done and that you don't owe them any money. The next thing you're going to need to do is you're going to need to provide information about debts and financial obligations. So for proof that you can pay for the down payment, and that way you as well, you don't have so many debts within a month of monthly payments, because they're going to want to make sure something called your debt load or your debt service ratio. I believe the magic number is 38% of your monthly household income. Anything larger than that, if you have like 45 or 50% going towards debts, you can't qualify for a mortgage because you have too much debt. So that is something that you're going to want to make sure that you collect all the information about your debts, spousal support, things like that, to make to make sure that you don't owe so much money where you can't afford to pay for a mortgage payment. So it's decided you're ready, you want to go get pre-approved, you have all this information, make sure that you are ready. So your total debt load is you shouldn't be more than 38% of your gross income, and this percentage is also known as your debt service ratio. Questions to ask your mortgage lender when you're getting pre-approved is how long they'll guarantee. Now this is important, how long they're going to guarantee the rate for. Will you automatically get the lower interest rates if they go down after you're pre-approved? And can your pre-approval be extended? Those are three really important questions. Ask your lender. So that's it for this educational series video on getting ready to be pre-approved. Call me or email me. I will guide you through the process and help you find a mortgage professional. Let my experience go to work for you. Been in the business for almost 14 years. I want to thank you for logging on wherever you came from either my YouTube channel or Facebook or Instagram or realestatenevin.ca. You were looking on the full library. You can find the whole library on realestatenevin.ca. Call me if you have any questions, 778-960-0699, or log on to realestatenevin.ca. Send me an email at info@realestatenevin.ca. I look forward to helping you. I've got a lot of experience